Good morning. Today is Monday, January 23rd, 2023. It was actually a relatively slow news weekend, which was kind of nice because that is going to change this week. We have a lot of earnings reports that we're going to get to. But on Sunday morning at 7 a.m., and it was 7 a.m. on the dot, so you know that this was a pre-planned article. Nick Timiraos, the guy with Powell's ear, he Jay Powell's ear at the Federal Reserve. He wrote an article for the Wall Street Journal at 7 a.m. on Sunday, essentially alluding to a slower and potentially lower pace of Fed rate increases. It was titled, Fed Sets Course for Milder Interest Rate Rise in February. Right now, Fed officials have projected that the rate will peak at between 5 and 5.25%. Which would imply a total of 3 25 basis point rate hikes over the course of the year. And it does look like the February 1st meeting will have a 25 basis point rate hike, which would mean there's only two left. The market is pricing in just two total rate hikes, which means that after the February meeting, there would just be one rate hike left before the pause. So the question is, Tom, why slow it down now? And will they potentially go even further and get closer to what the market is thinking, which is they're going to pause potentially sooner than expected?
I think they are essentially putting themselves in a position to try and not overshoot. I think the biggest question kind of within the Fed, and we saw the sort of commentary really from Bullard last week, is that what is the timeline on the effect of the hikes? Which is to say, are we now feeling the effect of the first hikes? Is the accumulated hikes, is that what's causing inflation to come down? Is demand really plummeting? Is it basically going to drop to zero, in which case they probably won't need to hike anymore? I think that's really what they're going for. It's almost like you get off the start really fast and there's a stop sign ahead of you. You can either just blow straight through it, or you can slowly decrease your acceleration and then eventually put on the brake and come to a stop at the stop sign. And they're trying to do that. But the question is, how far away is the stop sign? And that's where we're at. And I think that, if they're going to, I think their plan is to do three, but I think they feel very comfortable if things really change, if inflation really drops, if the job market really starts to get rough, then they're going to just do two. So that's kind of, I think, the base case. So I think the base case is hike next week on the 2nd or 1st, whichever the day is. I have to look what the actual day of the hike is. The 1st, hike again on March 22nd. And then at that point, I think they're going to be 100% data dependent. They say that they've got long-term projections and stuff, but every piece of information that comes out between now and then is going to affect whether or not they hike again. And if you look at futures, we're looking at 2.25 hikes. So we're taking the under right now in terms of how futures are marking it. And that peaks out in June. So the question is, do they hike twice, wait a couple months, hike in June? Do they hike earlier than that, or do they just pause? So that's where that 0.25 comes in. So right now there's a chance, but let's call it a 75% chance that they're not going to hike a third time. But all of that comes down to what's inflation doing? What are the prints? What are we seeing continued pain in these mega cap companies laying off 5 digits in people in a day? That's where I think they are. But Bullard is on the fence, or on the side of the fence, that says we need to continue to be aggressive, that the rate hikes have a shorter effect than you think, and we need to continue to push that. But I think for the most part, the rest of the Fed is thinking otherwise. I think at 25 and a pop.
Well, that's a great point, because there was this mention in the article that there's this growing division in the Fed. On one side, you have Bullard, who thinks that we need rate hikes faster and sooner to be restrictive and bring inflation down. On the other hand, you have what it increasingly seems to be everyone else. It's portrayed as this division, but really it almost seems as one or maybe two against the rest of the committee. And I think I know where Powell stands. And I think he's trying to tiptoe on both sides of the fence, but I think that he would grow with the majority of the committee. And it seems in the past that Powell has come out shortly after Bullard has made an announcement and pushed back on it, whether through back channel means or very overtly. And I wonder if he's doing the same thing again here. the people on Powell's side of the fence would say, look, why would we try to put the clamps down now on the economy, especially when inflation's coming down, and potentially really risk losing the things that we do have going, like the labor market? That's what Waller said last week. And I do have some empathy for that view. And I think that especially with inflation annualizing what it is right now on a month-to-month basis, you could make the case that interest rates are above inflation and that therefore the Fed policy is sufficiently restrictive at the present time. Bullard would push against that. But I would also look at a path, because you also need, it's not just the level of where inflation is, but also what the trajectory is. So, you could have blood pressure of 210 over 100, but that be good because it's coming down, or it could be bad if it's going the other way.
Yeah, Bullard is essentially looking at the scoreboard. He's up 28-3 at halftime, and he's saying, let's throw the ball around. Let's not run 3 times and punt it back to Tom Brady, to use a very local reference here. But that's where they're at, right? Their head, things are actually starting to turn. Question is, are they just going to try and run the clock out by running the ball, which would be 25 basis point rate hikes, or you keep throwing it and try and get up 35-3. So we'll see what the result is, but you play to win the game. You don't play not to lose.
In doing so, that you could throw a pick.
True, exactly, yeah.
So that's where the Fed is. Broadly, the big takeaway is they're getting more dovish. That is where the Fed is going. The Fed is becoming more dovish, which is translating to more to lower risk premiums and higher risk assets. And we've seen that in the stock market rally, especially on Friday. Secondly, Elliott Management took a large stake in Salesforce. That was announced over the weekend. Salesforce is up 4%. It's actually had a nice rally after some chaotic times there. So Salesforce multiple times has experimented with this co-CEO philosophy. Mark Benioff founded the company in 1999, and he's trying to set the vision as the CEO. But he's now brought in a couple of these co-CEOs. The first one was a guy by the name of Keith Block, and he took the job in late 2018, but he stepped down 18 months later in February 2020. And the second guy was a guy by the name of Brett Taylor. And Taylor, he kind of was the architect of the Slack acquisition, which was $27 billion acquisition that Salesforce made. And he was spending a lot of time as chairman of Twitter before it got purchased by Elon Musk. With CEOs and with other customers, and according to Benioff, not enough time on Salesforce product and engineering. So he left after just about 12 months at the company. And now they're laying off 10% of the workforce. And yet I'm seeing LinkedIn messages from former colleagues of mine or classmates saying, we're hiring, apply to Salesforce today. So there's many, many mixed messages over at Salesforce. And now you have Elliott Management making a large acquisition of Salesforce stock. They have historically been extremely aggressive as investors. They say in a statement, we look forward to working constructively with Salesforce to realize the value befitting a company of its stature. I think that there's more to come here, as is Elliott's want. Alternatively, they've also probably made a lot of money on this investment, and just the announcement of this, they're going to be up 4% today. So they may just flip out of it. So you never really know with Elliott Management, but they have a track record of being extremely aggressive with their investments.
Yeah, over under on the number of weeks before Benioff has some sort of
scandal,
some sort of cancellation. He, hit somebody, said something. That's Elliott's playbook. So if he's got any skeletons that they deem worthy of exposing, then they will be exposed, and he might be out sooner rather than later. Yeah,
he's gonna have to let them on the board if they want to be on the board.
Yeah,
or he's gonna have to be comfortable with skeletons coming out.
Yeah.
Regulators are coming for Goldman and Abbott. Goldman, this was announced on Friday in a Wall Street Journal report. Essentially, their consumer business, Marcus, you probably remember ads a couple years ago soliciting deposits and lending at Marcus by Goldman Sachs. This is their big push into retail banking. It has since been largely put on the back burner and kind of ring fenced. Right now, the Federal Reserve, though, is probing that business, saying they're trying to determine where the bank had, if the bank had appropriate safeguards in place as it ramped up lending. And it seems to fit well with the narrative that Goldman restructured some of its business units in its last earnings report, really almost trying to partition it out into this other entity and say, the Federal Reserve, if you want it, come and get it. We're not really doing anything with it. So I wouldn't be surprised to see some penalties in the future that Goldman has to pay, but it looks like they're going to try to avoid the Wells Fargo scenario by ring fencing it and kind of keeping it separate from the core operations of the firm.
Yeah, I mean, I think this might be the biggest misstep in the history of Goldman Sachs. But it was driven by the low interest rate environment. Goldman has always made money on trading and making markets and securities. And then they were like, man, and we can't make any spread on trading. Nobody wants to buy individual stocks and bonds right now. We're losing so much ground to TD Ameritrade and Schwab and, all these different brokers. So we're going to start our own. And then the environment flipped and suddenly, they've got this entity that they didn't really master. It wasn't a good idea, and so they're just trying to get out of it without making too much.
It's a commodity product. Yeah. I mean, unfortunately for them, and they were trying to use their brand, but they didn't even use their brand. They used Marcus.
Yeah. It's like if, I don't know, like Ferragamo was trying to sell Converse All-Stars. You know what I mean? They're like, we're rolling out these brand new shoes that cost $20, even though we're a luxury brand. Mm-hmm. And guess what? It didn't go very well.
Abbott is now under criminal investigation over its baby formula issues. We heard about this pretty early. We did have an investment in Abbott at the time. We've since sold pretty much all of it. We still have some tag ends that still have gains in it, and we want to be mindful of realizing gains. But they're under criminal investigation over their baby formula. Plant conditions were bad at the Sturgis, Michigan plant, basically allowing it to harbor a bacteria. But I mean, when I say bad conditions, they had standing water, the dryers didn't work, babies were dying. Now they said though it didn't genetically link to the bacteria found at the plant, but regardless, I mean, you have a deadly bacteria at a plant where you're making baby formula. That's not good. Abbott reopened the plant in June, last June, and their belief was that these issues are kind of behind them. Well, fast forward another 7 months, and they're looking at criminal investigation into this. And this is just an issue that we've begun to see a little bit, unfortunately, with Abbott just being a little bit fast and loose with the truth and massaging data and verbiage in ways that are probably legal, but also potentially misleading.
I mean, it doesn't help them that they dropped the ball and screwed up in a huge way. And then all of that got spun and stuck to Biden, so, who's probably like, hey, this isn't my fault. Let's get the FDA on these guys. Probably the administration.
That's a great point.
It's just, they were the ones who were in the wrong. Biden was forced to shut them down for good reason, but it ultimately came back to blame on him. And I think that, that doesn't look good. And so they're going to be punished accordingly.
We have a lot of earnings reports coming out this week, as we've mentioned. The big ones are going to be Microsoft tomorrow evening and Texas Instruments, the chip maker. Wednesday, you actually have Abbott reporting. So it'll be interesting to see what they say on that. And that's in the morning. Tesla in the evening. On Thursday, you have Visa and MasterCard reporting earnings. And then Friday, you have American Express, basically seeing, are we actually seeing a trend up in some of these charge-off rates that Discover Financial was talking about? Tomorrow morning, too, we'll also hear from Lockheed Martin. We'll hear from Johnson & Johnson. We'll be talking about those on the call. But potentially more interesting is now General Electric. There was a report this morning, actually, about large windmills from General Electric, Vestas, and Siemens. These windmills are just collapsing. They're taller than the Statue of Liberty, and they will just collapse. The structural integrity has been a little bit compromised by the speed at which they're trying to churn these windmills out. So that could come back on some of the utilities, but also some of the manufacturers. So I'm keen to see what General Electric has to say about that when they report earnings tomorrow morning. So with that, we'll leave it there. Have a great week. We'll see you tomorrow morning.